Okay, hi everyone. Gonna be the summary video here for chapter 12. We're looking at compensation, right? As a starting point, right? Let's talk a little bit about employees, right? Typically, we're gonna talk about paying them in money, right? So if we have George who works for the Yankees, right, he'll get a W 2. Typically, right, the corporation, right, they'll pay him the money, he'll include it as income, and they'll get a deduction for that as compensation expense on there on the books. We'll talk about the timing with that. But if we're focusing on the employee, right, you have to distinguish an employee from a wage employee, right? A salaried employee, right, they get maybe like 60 grand a year as a first year staff accountant, whatever the number is. And however many hours you work, you still get the flat pay on that. We said, you don't want to ever run the math on your hourly rate if you're salaried, because a lot of times, especially in public accounting, it's like minimum wage. But the idea with that is, here's what we're paying you. Whether you work 40 hours or 60 or 80, you're still going to get the same paycheck. Wage employees, in distinction, right? They tend to be paid on an hourly basis. So, hey, we're going to pay you $20 an hour. You work 4 hours, you get $80, right? Both of them are employees, right? Salaried versus wage. The income they get, right, is ordinary income. It's going to be subject to FICA tax that they kind of split the baby on, right? The corporation pays half and the employee pays half. And the tax document is a W 2 that they get, right? At the beginning of their job, when they first start their job, they'll fill out a W 4, which basically says, hey, how much should you withhold on the taxes? There'll also be like an I-9 that you got to fill out that deals with like citizenship and stuff like that and proof of identity. But essentially, these two are on the front end when you first start your job, and then you'll get your W 2. Typically, they issue them sometime at the end of January, right? So that's if you're an employee. If you're self employed, right, there's kind of like two flavors of self employed, right? If you have a sole proprietor, right? So, hey, I'm a roofer, I'm a one man show, I go and do roofs, I'm a sole proprietor, I'm self employed. Or you can also have kind of like contract workers, right? So that might be something like, hey, I'm working for Uber, right? I drive Uber. I'm an independent contractor for them. I'm a consultant, right? I'm going to come in for this one project and do some work. Both of these individuals are these type are self-employed. When they get paid, they get the gross amount, right? The entire amount, no with taxes are withheld. They have to send in quarterly estimated payments. Those earnings are subject to SE tax, the entire 15.3%. And the tax document they're going to get is a 1099 on there. Okay, typical setup here, just laying the land. Hey, we're paying our employees or contractors. We pay them cash. That's great from the business perspective. Now, if we're talking about George there as the employee, we also have to talk about the business or the corporation, right? The Yankees. As we've indicated, right, they're going to get a tax deduction for those wages that they paid George. Right? Generally, it's for the reasonable wages. To the extent it's excess, it's beyond reasonable, you wouldn't get that. So, hey, if you're paying everybody $20 an hour to be the cashier at the food stand and you pay your brother $40 an hour, right, you're not going to be able to get a deduction for all 40. They'll claw that back to 20 on there. Otherwise it would be unreasonable. The next question is, so we talked about what they get, right? They get a tax deduction. The next question is, when do they get that? Well, it depends on if they're cash or accrual method, right? If the Yankees are cash method, right, they get the deduction in the year they pay it, right? Cash out, expense. Hey, we pay it in year one, we'll get a deduction in year one. If they're Accrual, which most large corporations especially are accrual, then it's going to be when the employee performs the services, right? It's like, you accrue the insurance as you use it, you pay the employees or as they work, you accrue the expense. Similar thing here for tax. You get the deduction when they perform it. Now, one little kind of like oddity you do have to be aware of is you can get the deduction in year one, even if you pay in year two, as long as the payment occurs within 2.5 months of tax year end, right? This is going to be the general rule for it. So let's look at 12.1 to show this. So the facts here, they say, hey, we paid $240 to the employee in the current year, right, in year one. So, hey, you're going to get the entire deduction in year one. The next thing they say is, okay, we paid the employee for $240,000 of salary, right, and a bonus of $20,000, right? So we're into this in total for $260 on there. The bonus was fixed before year end and was paid on February 1st of the subsequent year, right? So in other words, we have year one, right? This bonus, right, we must pay right here within 2.5 months, right? So the setup here is, how much are they going to get to deduct in year one? Right, well, they'll get the entire $260,000, the salary and the bonus. The reason being is this was within the window, right? Within that 2.5 months on there, you'll get it on year one. This is showing the general rule, right? They go down here, they give an alternate. They say, what if, right, it was paid in April 1st, right? Let's say it was outside the window, right? It was like over here. Well, in that case, right, they'll be able to get the $240 for the salary, right? Because, like as they earned it, they paid it in there in year one. But the $20,000, right, they're going to have to kick the can. They'll only be able to get the deduction in year two for that because it's outside the window. So this is the general rule, the framework, right? Look to see within that 2.5 month window. If it's within it, you get it on year one. However, right, there is an exception to that general rule, right? We said the general rule is 2.5 months. However, even if you pay it within 2.5 months, right, you still will only be able to deduct it in year two if the employer is an accrual method, the employee is a cash method employee, and the two of them are related parties, right? When we have this set up, right, where it's like the corporation is accrual, the employee is cash basis, and most individual taxpayers are cash basis, even if they pay it within the window, right, we're still going to say year two, right? This is the exception to it. So general rule, within 2.5 months, you get it on year one if you pay it in year two. The exception says even within 2.5 months, you get it in year two when you pay it in year two on there. So that's what this 12.3 is showing right here, right? We meet that criteria. Oh, they're related parties. The corporation is accrual, the taxpayer is cash. Even though it was accrued, we can't deduct it until year two. This is showing the exception, right? That 20 grand we get in year two, even though it was within the window, okay? The other thing to be aware of, right, the after-tax cost of salary, right? This is just recognizing that, hey, corporations get a deduction for that compensation expense, so we got to factor that in, right? So here, yeah, we pay our employee $240,000, but remember, we're going to get a compensation expense, a deduction for that, which offsets of 21%. So when you back that out, 1 minus the marginal tax rate of 21%, 79%, it's really like, after we consider the tax consequences of it, yes, it's 240 on paper, but when we back out the tax benefit we get, the deduction, it's really like we're only paying 189 on there to that employee. So that's the setup there. The other thing to be aware of is there are limits, right? So there's a cap on what you can take as the expense, right? We talked about what it is. You get a deduction for compensation expense. When you get it, the general rule and the exception. Now we're going to say, what are the limitations, right? And the limitation is essentially this, right? And this is under current law, 2018 and onward. You can look at prior law, right? I'm not going to be concerned with like old stuff, but there is like certain people who are grandfathered in. But right now, under current law, if you have a covered employee, like a CEO, a CFO, right? Like Elon Musk here is the CEO of Tesla, you're only going to be able to get a deduction for up to $1 million of compensation expense for that individual on there. Let's look at 12.4. Right, so hey, we have Elon Musk, right? He's our CEO. That's great. We pay him 1.5 in salary and 1 in bonus, right? So all in, right, we're paying him 2.5 million. The idea with this though is because he's a covered employee, right? We're going to cap that at 1 million, right? So we run the numbers on that. Okay, we're only going to get a deduction for 1 million. When we back out the benefit that we get from the tax deduction, truly it's like he's only costing us 2.29, right? We use that all-in number up from above. That's the total compensation. We back out the tax liability or the benefit we get here of 210 from that, which is based on the cap. That gets us our, after-tax cost of compensation for that employee. You can look, at this if you want. Just be aware some people are grandfathered in, right? There's old rules for prior to 2018. You can check that out. So that's the idea with, basically paying cash to our employees. We talked about the employee, right? It's generally going to be ordinary income. Depends if you're, employee or independent contractor there for like FICA versus SE. We talked about from the employer point of view, when they get a deduction, the limitations on that, the timing. All of that is with money, right? The next thing we're going to say is, right, we're going to talk about equity-based compensation, right? So we're still compensating the individual, but we're not giving them money, right? We're going to give them like some type of stock or something like that, right? There's various different kind of iterations of this, but the idea with it is, hey, one way I can pay you is money. The other way I can pay you is in stock, right? I can give you a stock option. Now, there's various types, right? There's non-qualified options, there's ISOs, there's restricted stock, when you make an 83B election, and there's restricted stock units. Each of these, right, the thing you always got to remember is from the employee's point of view, right, when is it taxable? And then 2, what is their basis in the stock they receive on there? From the employer's point of view, right, the main thing you need to know is when do they take the tax deduction for the compensation expense? Right, so from like the business's point of view, when they get the compensation expense. From the employee's point of view, when is that stock option taxable and what is the basis in the stock that they received on there. So we're going to use this kind of a continuing example here of Cramerica, which is the business. We'll just say it's a C Corp. We have Darren, who receives non-qualified options. We have Jerry, who receives incentive stock options. We have Elaine, who receives restricted stock. We have Susie, who receives restricted stock but makes an 83B election. And we have Frank, who receives restricted stock units on there. Let's kind of look at, a couple of these, and then I'll pause it because it's like halfway through the video, and we'll look at the other half in the next video. So first off, let's talk a little bit about a stock option, right? So we said, we have the business, the C Corp, right? They want to pay their employees, right? That's great. We said one thing they can do is give them cash. Another way they can compensate them is give them a stock option, right? Or a stock in there. What is an option, right? A stock option. Well, this gives the holder, right, the employee, the holder, the right, but not the obligation, right? You don't have to take us up on this, but we can give you the right. You have the option to do this, to purchase the stock in the future at a price we set today. If there's a built-in gain, the employee almost always is going to take them up on this, right? So here's kind of the deal, right? We will give you, right? Cramerica will give you, the employee, right? In 1 year from now, right? We will give you the option to buy the stock at $100, right? So here we are today, right? In 1 year from now, you can buy it at $100 on there. Well, if it's 1 year later, right, and assuming you still are working for the corporation, one of the reasons they have these stock options is so like you don't leave, right? There's like vesting periods and things like that. But let's say right now that stock is trading on the open market at 125, right? Well, like you can buy it for 100, sell it for 125, right? It has a built-in gain there of 25, right? That's kind of like the idea of what you made or could make on the stock. So we will see, right, if you look at the examples, right, how and when and for how much and what is the basis in that stock depends on, the type of stock. Generally, right, the general rule is going to be that most stock options are these non-qualified options, right? So a non-qualified option is any option that is not an ISO. So what does that mean? We got to go to the ISO here, right? An ISO, an incentive stock option, is basically one that meets certain holding requirements. It's kind of hard to satisfy these. We'll talk about it. But the general rule is non-qualified option. The exception is, hey, if you meet special rules, we'll give it ISO treatment on there. In this framework, right, for all really types of stock, there's kind of a lot of important dates for it, right? We have the grant date when the employee is allocated the stock options, right? So the grant date is going to be up front. We have the vesting date, which says, hey, here is where this deal, this option we give you, you actually vest and have the right, the ownership, the property right in this such that you can take us up on it. We then have the exercise date where you actually do take them up. Oh, okay, I can buy it at that amount. I'm going to buy it. The strike price is basically what you pay for it, right? That's another way of saying, oh, what are the terms and conditions, what you can buy it for. And then the bargain element, right, is this guy, how much you make on it, or you could make there. So you can see there's a grant date, a vesting date, an exercise date. Ultimately, right, there's a sell date and an expiration date, right? So the sell date is like, okay, I exercised it here, I sell it there, and then The expiration is kind of like the whole period that you could have like taken them up on this. Let's start here with basic stock options, right? So we said that there are two flavors, right? Most of the time they're going to be non-qualified options, but the exception will be that they're ISOs, right? ISOs have special rules, like special holding period that we'll see. In other words, you have to hold it for a certain amount of time to get this qualification for an ISO on there. We said, right, most are NQOs, the exception are ISOs. How you classify these, right, like whether it's restricted stock, ISO, non-qualified options, that's going to affect the tax consequences on there with it. So starting with non-qualified options, the general rule, most of the time it's going to be that. So we have the intern, Darren, who is working for us. Hey, we're going to compensate you with some non-qualified options here. And essentially what happens here is for Darren, right here, we said that there's kind of two questions, right? When is this taxable to him? For how much? And what is his basis? Right? Well, with regard to the when question, it's essentially, right, if we go over here on the exercise date, right? That is when he's going to have to say, oh, okay, I bought this in year 2. I exercised it. It's going to be income on my year 2 return. Well, then the next question is, for how much, right? How are we going to quantify it? Well, whatever the bargain element is, right? If you make $25 on each share, well, then it's going to be $25. And if you buy 10 shares, it's $250, 25 per share times 10. Likewise, the basis Darren will have in that stock, right? Okay, I buy the stock on this date. That's great. I exercised it. I'm going to buy it. If later on he sells it, right, like say 2 years later, and he's going to have the amount realized minus adjusted basis gives the gain or loss, right? Well, what we're going to do here is we're going to say, oh, okay, his basis in it is the fair market value on the exercise date, not what he paid. Right, so the basis in this case, right, he'll have income for whatever he made on it or could make, right, that built-in gain. And the basis in that stock is going to be whatever it was worth on the open market on the exercise date, right? So the fair market there becomes his basis later on. Let's look at 12.8 here. All right, so we're dealing with non-qualified options, right? The idea with this is we know it's taxable to the employee on the exercise date for the built-in gain on there. On the exercise date, right here, they exercised 20,000 options and he could buy it for $5, right? So he paid $100,000 on the open market, right? The market price is $20 a share, right? So what he got, right, the fair market value of what he got was 400, right? Well, if he paid 100, but what he got was worth 400, right? It was like he made 300,000, right? That is going to be his ordinary income on that date, right? 300 grand of ordinary income. His basis in that stock he received, right? So now he's sitting on 20,000 shares. Well, his basis will be the fair market value, right, of what he got, not what he paid, right? That would be wrong for the basis. His basis is, what it was worth on that date. So you can look at, those other examples that then says, oh, and later on in year 2 or 3 or whatever the case is, he sells it. If he sells it for 500 grand and his basis is 400, he's going to have $100,000 long-term capital gain. So that was the general rule, right? A non-qualified option. Now we're going to look at the exception, right? Let's say we have Jerry. He's another one of the Kramerica employees. We say, hey, Jerry, we're going to compensate you and give you some incentive stock options, right? Now, they're less common, right? That's why they're the exception. And sometimes they'll be called statutory or qualified options. In any event, right, if you want to have an ISO, right, you have to meet 2 holding periods, right? So it's an and each of these. In other words, the employee must hold it for at least 2 years after the grant date, and they must hold the exercise ISO stock for at least 1 year after the exercise date. So they got to hold it there for a certain time. If they meet the holding period, right, like check mark, right, we meet it, that's good, then it's considered a qualifying disposition. If it's a qualifying disposition, right, what happens here is, right, so it says if meet both holding periods, then qualifying disposition, and bargain element at date of sale is taxed at a long-term gain, right? So in other words, the date of sale later on is when we're going to pay the tax on it. The basis in this case is what he paid, right? This time it is what he paid, right? So you got to keep these in line here, right? So we look at it, right? It's an ISO, right? You don't pay tax there as the employee on any of those dates. It's only later on when you sell it will you pay the tax on it. Let's look at, let's see here, example 12.9. All right, so we're dealing with an ISO, right? It looks like they exercise at 5,000 options at a $5 strike price. So they're saying, oh, okay, here's the exercise date. Jerry bought some of it then. Can you please tell me how much income he's going to have? Well, if he meets the holding period, check, right? He's going to have $0 of income on the exercise date, right? In other words, his income is only later on when he sells it, right? So in this case, right, no income on exercise date. And then if we say, oh, what is his basis in that stock? Right, well, here the basis is going to be what he paid on there, right? So 5,000. Later on, right, it says, okay, well, we said on the exercise date here, nothing for Jerry, right? $0 of income. We know it's later on when he sells it. Then they say, oh, by the way, he did sell it 5 years later for 125 grand. Well, here what happens is he sells it for 125. His basis is 25. What he paid, right? That's going to be the long-term capital gain, right? That is when Jerry pays tax whenever he sells it over here, long-term capital gain on the built-in gain. Right, so you can look at this kind of flow chart on there. Don't memorize these exact things. It does get a little bit tricky. Like we're talking just about like income tax. It gets a little bit more wonky when you're looking at like the other kind of FICA and employment taxes and stuff like that. I just put this in here. This is a nice little kind of summary chart. You can look at the 2 kind of setups here, right? If you meet it, the holding period, or you fail it, right? If you fail it, right, then it's a disqualifying disposition. And essentially, right, it's going to be similar treatment to the non-qualified options. You can look at 12.10 there. Less concerned with that for the exam, right? If I'm going to test the ISO, I'm going to test what it is, not what it's not. I mean, it can be a disqualifying disposition, but I want you to know more of the basics, right? Long-term capital gain when they sell it, basis is what they paid for it. Now, one of the things, right, we try to do here, right, we talked about Darren, the intern, right, when he has the income, what his basis is for the non-qualified option. We talked about Jerry, the other employee, when he has income, what his basis is. How about from Cramerica's point of view, right? The corporation, the business, we know they're going to get a compensation expense, right? If they pay wages to the employee, money, hey, we'll get an expense for it. When do we do it? When do we get the deduction here for these stock options? Well, from Cramerica's standpoint, right, the general rule, what we're trying to do is match, right, overall. So whenever, as a general rule, when the employee claims it as income, then we as Cramerica will equally get the deduction. That's generally what we try to do, but ISOs, we'll see there's an exception here. So non-qualified options, right, we said we're trying to match. Well, in non-qualifying options with Darren, he has the income when he exercises it, income to employee on there. Accordingly, from Cramerica's point of view, right, if Darren claims the income when he exercises it in that year, we're going to get the deduction on our 1120 for compensation expense in that year, right? That is for a non-qualifying option, right here, an NQL. For ISOs, it's a little bit of a different story, right? As a general rule, right, Cramerica, sorry to tell you this, frowny face. You do not get a tax deduction for this, right? So for a incentive stock option, yes, Jerry, you claim the income when you sell it, but we're going to depart from that match, right? Tax ISO, no corporate deduction as a general rule, assuming it's like a true ISO. It gets a little bit wonky if it's a disqualifying disposition, but it's out here. He's sad. We don't get anything for a tax ISO on there. So talked about that. The last thing to be aware of is, this can give rise to book to tax differences, right? What we do and how we calculate stock options, because like remember book, FASB, intermediate accounting, right? You also get a compensation expense, but they have their own rule for what they do, right? Essentially what they say is for book, right, for both types, you have to estimate the fair market value on the grant date and amortize it over the vesting period, right? So, here's the grant date. Let's just say we think this stock option that we're giving Jerry is worth 100 grand, right? That's great. Remember, this is for book, right? So it's a 2-year vesting period before he gets this, right? So year 1, we're going to amortize it in half, $50. Year 2, we're going to amortize it $50, right? These are book deductions that we get for compensation expense. You can see this is going to give rise to a book to tax difference because for tax, right, 0, 0, right? Jerry is only, claiming the income here. And no, if it's an ISO, right, we don't ever get any deduction for this, assuming it's like a qualifying disposition on there. So with that, I'm going to end the lecture here. We'll pick it up with restricted stock in the next lecture.